Hi there, it's Mark Yagi. I'm the author of this book on covered calls. Welcome back to the channel. In this video today, I'm going to show you how to take a 1.4% return and turn it into a 3.6% return in just 1 week. So stay tuned. Mark Yagi here today. Glad you're joining us. I'm the author of the Cash Flow Machine book, the courses, the mastermind, everything that's around it. And my goal of putting out these videos is just so you can learn how to do these strategies all around covered calls, because covered calls to me are a very conservative strategy in all markets because you're getting income, which helps you protect the downside. Not if things crash, of course, but it does help you protect the downside because you're getting that income. That allows you to play defense. On the other side, you're getting that income. That's offense. So you're using the income to lower your basis in your stock. So today I'm going to be talking about Netflix. Now, Netflix has kind of gone crazy in the last week. And I think it's just there's a flight back into Netflix after it's been down like crazy in the last, I don't know, year and a half, something like that. Take a look at this chart on Netflix. You can see where it swooned all the way down from like 600 down to 180. Ouch, right? Like you didn't want to be in Netflix during that period of time because it's really hard to make money when the stock is doing that. And then you have to wait all that time for it to come back. And that's fine if you're collecting what we call juice, if you're collecting the time premium. But you'd rather be in a stock that's staying consolidated or going up. Now, we are in a red market, so I'm not necessarily entering in this trade. I'm just showing you this trade because it popped up on my screen today. What we do is we buy the stock and we sell the call normally in covered calls. You can go get a zillion other free videos on covered calls all around YouTube, and they'll teach you how to buy the stock and sell the call. But I'm going to go a little bit further today because in the Cash Flow Machine, the program, the courses, the masterminds that I have, we teach people the nuances of buying the stock and selling the call. In fact, we teach them how to do what are called synthetics. They're basically credit spreads, and I'm going to show you one of those today. Now, I'm not saying you go out and do this. I'm saying this is good for consideration so you can start getting the reps at doing the numbers, and I did the numbers for you, so no math involved here. I'm just going to show you what we did. But look at this chart. So you can see it's been in an uptrend since like the middle of June. Nice uptrend. It hit a high of near 400, like 380, and then it came back down over the last 5 or 6 weeks, and now it's bouncing off of that consolidation level of a couple of weeks ago. And it's bouncing on pretty decent volume. So to me, Netflix looks like it has some good relative strength. In fact, you can look at Market Smith's relative strength rating. It says 92. That's pretty good out of 100, or 99, which is their highest one. So the stock looks pretty good. The market doesn't look really good. So I'm not saying you enter this trade, but it's something you can put on your watch list. But let's say we did enter this trade today. Now, if we went out and just, bought the stock, and we sold the call, the stock is around, let's just round it up. It's like 327.90 something. Let's just round it up to 328 for numbers, okay? So if we go out and we buy the stock for 328 and we turn around and we sell the calls, let's do, since we're in a red market, let's be safe, right? We could do it at the money, but then we have no cushion on the way down. If we could do like the 315s here, okay? The 315s are $17.25. That's how much we get back when we sell a call. We get the bid price. So we get back $17.25. Pretty good, right? So the stock's at like 328. We get $17 worth of cushion that it has to go down before we start to even lose money. The juice in that is $4.11 roughly, because it's shifting all around because of bid-ask spreads, but roughly around $4.11. That works out to be, well, I'll show you the numbers. If we buy the stock, we sell the call for $17.25, we put in the inputs, right? 328, that's the stock price. Then we go the short call price, $17.25. Our strike is 315. So you might be saying, well, why aren't you just doing the at the monies? Well, at the monies aren't going to pay you that kind of $17.25, which includes that in the money cushion. If the stock goes down, you don't lose money because you're going down dollar for dollar. So you're gaining on the short side and you're losing on the long side, if that makes sense. Okay. So those two offset, but you do get the juice. Okay. So let's go down to the bottom. So the strike price is 315. We're going to assume this is 5 contracts, 500 shares, and this is a 1-week contract. So this expires in a week. Today's Friday, the 24th of March. So it expires on 3/31. So our basis after we, take 328, subtract 17.25 from it is 310.75. Our juice, which is calculated from those numbers, is about what we showed you on the other screen of the options chain, and that's 425. So the percent of juice, the percent that we make, our profit is 1.3%. Okay. So on $155,000 invested for a week, we end up making $2,000. And by the way, it's a lot safer that it's going to happen because the stock has to go down to 315 for you to start to be below the strike, which is where you start to lose money. Anything above 315 and it's at 328, you get that cushion, right? So that cushion helps almost like increase the probabilities that you're going to get that, make that profit on the trade. Who knows? Anything could happen. We're in a red market. That's why I'm not entering the trade today. But if you did enter the trade, this is how it would work out. And you can check this in a week and see if it worked out, by the way. So, and by the way, when you do that, just check and see if the stock closed next Friday, the 31st of March, over 315. If it did, you make what's on this screen. Less commissions, okay, but commissions are small. All right, so the return on investment for the period is 1.37%, about 1.4%. And if you were to do this every week, and I'm not saying you do it every week, but if you can do this, you make 1.37% a week times, 52 weeks, it's 71% in a year. Not too bad, right? I mean, I don't know a lot of people that make 71%. Now, again, you don't always make that. Sometimes the stock goes down, but the more in the money you are, the more guaranteed, I hate to use that word, but the more guaranteed you are that you're going to make that money, right? You'll make less at the money. You'll make more if it stays above the strike price, but you'll make a little less when when your strike price is down, but you have all that cushion. I hope that's starting to make sense. So the whole position, and I want you to notice this, is 155,375. All right. You got that? So you buy the stock, you sell the call, you make about 1.4% for the week. Okay, so let that sink in for just a second. Now, what if instead of buying the stock, because that's $155,000 you got to come up with out of your pocket, sometimes that's a lot for people, right? Well, what if there were a different way? And I'm not saying you go do this because there's a lot of things you need to learn before you do this kind of a trade. But instead of owning the stock, you controlled the stock with a deep in the money option. Okay. You control the stock with a deep in the money option. Now, let me show you what I mean. So instead of buying the stock, which is $328 a share, you actually can control it by buying the November, in this case, you look at your option chain there, the November 17th, 2023. That expires 238 days from now. There's no threat of it expiring here in the next couple of weeks. So we're going to go way out, giving us plenty of time that if the stock moves up and down, we can handle it. And we're going to sell the 210s, okay? So the 210s are our base. Now, the way I look at a base, either a stock or the base position, which is an option, synthetic in this case, is basically the right to sell against it, right? It doesn't really matter if you have 1,000 shares or 10 contracts. You could still sell 10 contracts against it, right? So that's what the options do. But they're so much cheaper when you're on the long side. When you're deep in the money, I'll show you what I mean. So I'm not going to go through all of them, but I'm going to show you that these 210s will cost you for the next 238 days, $11.81 of time premium. Okay. That time premium goes down. So that's a risk, but it's $12 over the next, 9 months or so, 8 months. Okay. So it's not that big a deal. It's maybe $1.50 a month or something like that. All right. It's going to cost you $134.35 to get into that trade, to do that. Now, that's a lot cheaper than $328, right? So you can buy a lot more of it, which means you could sell a lot more on the upside, right? On the short side. And so if you could sell more on the short side, you make more money. Now, there's risk in everything, right? If you're going to do synthetics, you got to know how to do synthetics. We teach that in our courses. We teach that in our mastermind group. And there are lots of little nuances to it, but I'm going to just point these out. To some of you, it may mean something. To some of you, it doesn't. But the ones that may mean something, I'm going to point it out. This has got a delta of 90.5. Okay. That means that the stock will move basically in tandem together with this option. But if it goes up, it only goes up 90%. If it goes down, it only goes down 90%. So there is a risk there. It's a built-in risk. You can't have something for nothing. You could buy 3 times the amount of Netflix that you were going to buy, or control it, I should say. But there are some risks that you need to know about when you do that. So let's plug into our calculator now. Instead of buying the stock, Now I'm going to show you that if you buy the synthetic on the base, instead of paying $328, you pay $134.35, right? So you pay $134.35, and that is for the 210s. Just double checking my math there. Now you've paid $134.35 for the base. You still get your $17.25. So that doesn't change, but now you're in this a little bit cheaper, but you're still controlling the same number of shares. Now, look, if you go all the way down, we'll show you what the juice calculated is. It's 425, it's the same as it was before, but the percentage is now higher because you have less cost out of pocket. You can go to that black number at the bottom, and you can see that instead of spending $155,000 on the position, we're spending $58,550, or a third of the price, right? Now this becomes a little bit more achievable. A lot of people call these poor man's covered calls. I don't know. I know a lot of rich people that do them, so I hate that name. These are synthetics, in my opinion. This is a credit spread, but it's a system that you should, if you like this, you should implement. So anyway, you can buy 3 times as much, or you can, only invest a third of the amount you would have invested before. But look at what happens to your return. Now, instead of your return being about 1.4% for the week, it's only 1 week, which is still pretty darn good, by the way. Now your return goes up to 3.63%. Okay. That's really good because now it annualizes at 189%. Okay. So now you're really getting into some major percentage increases. But like I said, a lot of things can happen when you have synthetics as your base. The stock goes down, right? And it doesn't come back up. You don't have the luxury of waiting 2 years for the stock to come back up. You kind of, you have an expiration date on your base. The delta is an issue, and I'm not going to get into deltas on this video. There are just a lot of things. If the stock goes higher than your strike price, which it already is, if it continues to go higher, you're not getting dollar for dollar like you would on the stock. You're only getting 90% of the increase. So you have to commit for the long term on this trade. It's not just I'm in it for a week. You now have to be committed to it for the long term, because if it keeps going up, you're going to have to use some of your working capital to buy it higher. That's part of the risk. There's always risk in the market, but we're talking about making 3.6% in a week. That's how I do it, right? This is a 1 week trade, but I'm not saying you're out in a week. I'm saying that after a week, you do something again. Normally what we do is we roll our calls to the next week or the next month or the next period, whatever it makes you comfortable, whatever is the safest thing for you. So let me recap this. You can buy the stock and sell the call. That's a typical covered call. That's what most people do. Or you can juice it up a little bit by buying the synthetic and replacing the long stock with a long call. Now, I don't like buying stock long, right? Or options long, because there's a time frame that works against me. You saw it's about $11, $12. That's okay. You see how much juice I'm getting every week. I'm getting $4 a week, on the juice. That's $16 in a month. That pays for the whole period of time that I'm going to be in this. So I have to commit to not just a week, but I'm going to do this every week. So that's what we're doing on Netflix, or I'm showing you on Netflix. And if you like what we're doing here, give us a like, give us a subscribe, give us an attaboy, hit the notification bell so you know when these come out. I mean, I'm making this on Friday. I'm hoping it comes out on Friday so that you can kind of take a look at it real time and watch it over the next week. If not, this is instructive anyway. And then if you want to learn more, go to cashflowmachine.io. And we have a program there that's, lots of different courses. We have a mastermind, and our mastermind is like a group of people. It's a community. It's the courses. It's mentorship from me. It's mentorship and community from the other people. And every Friday we get on a call on the afternoon and we go through our trades and we make sure that we're doing the right thing. We learn from each other. We chat about things, and we have a pretty good time while we're learning too. So anyway, enough about that. My point of these videos is that you learn how to do these. But in order to do these, you need a system. You need to learn how to do it the right way. Our system shows you how to do it the right way. Maybe somebody else's does too. If you're going to do them, educate yourself about them so that you can be a better investor. See you next time here on this channel. Thanks. Hi, Mark Yegi here, wealth architect and creator of the Cash Flow Machine investing system. Listen, what you just saw is just one part of my system for creating reliable income of 2 to 4% a month from the stock market. But you know that if it were that easy, everybody would do it, right? So if you want to learn how to create investment income the right way, then you need to learn and have a system with rules and what-if strategies so that you can learn what to do when the market goes against you, what to do when the stock goes against you, how to adjust your trade so that it's always in a winning position, how much to risk, how to build a multi-million-dollar portfolio that creates income of $10,000, $20,000, or $30,000 a month in semi-passive income. Best of all, the whole cash flow machine system takes less than an hour a week to implement. Just go to the link below to learn more about our system or go to cashflowmachine.io. See you there.